University, is a member of the American Institute of Certified Public Accountants and the New Jersey Society of Certified Public Accountants. So without further ado, I'll turn the presentation over to Mark, and he'll talk to you about the revenue recognition. Just a couple of quick housekeeping things, though. If you do have questions, please put them in the chat box, and we'll get to them. There will be a little survey at the end of the presentation that we'd like you to fill out and send back to us, so we have for future reference. And with that, I'll turn it over to Mark.
Thank you, Ken. Good afternoon, everyone. Certainly appreciate the opportunity to be in front of, or at least electronically in front of the group, to talk about a standard that, from my perspective, is a very impactful and broad-ranging standard. In our firm of Eisner Amper, I'm in our professional practice group, which means that I'm one of the back office accounting readers and interpreters. So it's nice to be out of the office. They rarely let me out. So this standard for me has been very exciting on a lot of levels. It was one that was large enough that we've actually been tracking it as a profession for years, waiting for this to come out, and we'll talk about that a little bit. A couple of things I'll just preface about this before we really start in on it is that the types of questions that we generally get high level is revenue going to be faster or slower under the new standard, or it's really pretty much going to be the same as it is now, or some semblance of that. And from that perspective, it's a difficult standard to give any one answer because it's going to be different not only by company but by revenue stream. So your large international companies that have 5 or 10 or 100 different revenue streams will actually have to apply this standard to each type of product, service, or other deliverable that they're really in the marketplace delivering. So there's some companies where, and we'll talk about more specifically, where revenue might be coming in on a little more accelerated basis than in the past. Others may find that revenue recognition is delayed, deferred a little bit longer. And some, after they go through the whole model, may actually find out they're pretty much where they always have been. So it's one that our hope is that people start thinking about it and at least getting to the point where they don't just simply underreact and say, oh, a new revenue standard's out. How could it be any different than where we're at now? So this particular standard is interesting on another layer. We talked, if you rewound a handful of years ago, everyone was talking about the international standards, and was the U.S. going to international standards? Are we going to wake up one day and just use their standards? And what the FASB and the International Accounting Standards Board elected to do was to say, let's pick a couple of really large projects, and we'll come out with converged standards. So we'll deliberate together, and we'll come up with some standards. And then, at least for these really big ticket items, we will be converged with the international standards because we're going to be concurrently developing them. And there was a handful of projects that they started that with, revenue recognition being one of them. So, the FASB, to their credit, they try to take painstaking detail to go through standards when they're coming up to address everything that could possibly come up. So the standard setting process is a long one. Add in the layer of getting the international guys to the table, and this whole thing has been in the works for the better part of 10 years. So this one's really been brewing for a very, very long time. It replaces all U.S. GAAP on revenue recognition with a couple of exceptions, and that's a model that the FASB's been going to. They set a very wide net, putting everything into scope, and then they say, okay, maybe we caught a couple things that we didn't really want in the standard, and then they'll scope it out specifically, and we'll talk about some of the industries that are scoped out. But on the whole, everything is under this, which is sometimes a big, big thing to get people's head around. I'll finish presenting this, And people will be like, well, we can still do percentage of completion, right? They didn't take that away, and it's like, well, really, this is everything. So a quick snapshot of where we're at now. This is courtesy of the FASB, and this is basically trying to, in essence, compare, contrast where we are with the proposed model. So under current guidance, if you look at the left side of this screen, there's general revenue recognition concepts, and the profession was very familiar with these, and some of them are very translatable into the new standard. But they wanted evidence of an arrangement. They wanted to make sure that you'd actually delivered your goods or services. They wanted to make sure your price was fixed, and that you'd actually end up collecting the money. You don't want to be recording revenue on amounts you're actually never going to collect. And that was really the general framework, and it really captured, a good part of really the legacy industrial aspects of the U.S. infrastructure, being manufacturing, retail, distribution. They kind of all fit under that. Then over the years, what GAAP, fortunately or unfortunately, started doing was taking this Band-Aid approach. And they said, well, construction, you guys don't really understand our construction, so they came out with construction and production type models. They came out with software revenue recognition, real estate sales. All told, I think there's about 200 discrete pieces of revenue recognition guidance currently under U.S. GAAP. And as a general rule of thumb, if you were under the general recognition standards, think Walmart, you go to the store, you buy some batteries, you give them some cash, they give you a receipt, you're pretty much going to land exactly where you were under this standard as you historically did. As soon as you get into the industries that were under their own type of guidance, you're probably going to see big swings to how revenue gets recognized. Moving over to the right, we get into, well, what is the proposed model? And many of us practitioners like myself kind of had this view about revenue recognition, and there was enough in the current standards that you could interpret this. But under the new standard, the FASB actually explicitly said this is a customer control model. You need to look at a revenue transaction from the perspective of the customer, and we're going to keep getting back to that. And quite frankly, this is probably the biggest change in people's mindset, because historically, a lot of times companies kind of felt like, well, I've done a lot of stuff. We've incurred a lot of costs. Like I must be entitled to or otherwise deserve some type of revenue for what I've done. And the FASB really said, throw out what you've done, and let's say, what does the customer have? And we'll talk about how that gets applied. So it's really a customer control model, which is fundamentally different in many regards than the current models we're under U.S. GAAP. I mentioned before they basically scoped in everything, and then they have to say, okay, we overgrabbed with what was in scope, and we're going to pull out a couple of things. Insurance, it was just impossible to really get insurance industry to fall into this model, so they've been scoped out. Leases have been specifically scoped out as well. As an aside, there is a very large lease project that's been going on about as long as this revenue. It's another co-project between the two boards, and it's meant to come out and replace all of our guidance on leasing. Thought it was going to pop any minute now. It's apparently, the word on the street is it's a little backburnered, so it's a little less focal. But if you are a lessor or a lessee, that's one of the standards you might want to be looking at as to what might be coming down the pike. So back to the revenue standard, we've got retrospective application with a couple of practical expedients. And in essence, what that really means is companies are going to have to show revenue under the new standard for all periods presented. And I have a slide later on that depicts that. At first that sounds, okay, that's plausible. You're going to show multiple years and you want them to be comparable, so you kind of have to recast it. Where this kind of becomes a pain in the neck is if you think of a public company that has to adopt this, let's say January 1 of 2017, when they show their 3 years of financial statements, you're going to have 2015, 16, and 17, which really means starting January 1 of 15, which I think is past already, you're kind of in play, which is a pain in the neck because right now you're kind of reporting under existing GAAP.
Yeah.
Best practice would be like on a off on the side, tracking under this GAAP, so that you can cut it back over when the time comes, which is basically you're forced to keep two sets of revenue books now, which is potentially problematic. And then you layer in if you're a company that has multi-year contracts. So if you entered into a contract and your contracts are 3 years, you could have entered into a contract in 2012 or 13 that's running out in 15 that you're going to have to kind of do both ways. So the FASB, says we gave the industry a long time. It's 2017 for public companies, 2018 for private companies. But when you start looking at the nuances, it's coming in a little faster than they thought. The goal is to provide a single model, hoping to promote consistency. My personal view is I think it's an academically very sound standard. Sometimes, however, I feel like when you try to do one size fits all, sometimes what you end up getting is one size fits very few. So there are many industries that right now, as a profession, we're struggling with, like how does not-for-profit really fit into this? How do people that you have Medicare, Medicaid transactions fit into this? Sometimes it's difficult to apply a very academically broad and general standard to the specific. So that's kind of where we're headed with this. One of the phrases that's coming up frequently at the FASB is the economic substance, and I think they feel that over time accounting has kind of drifted from the underlying economics of many transactions. So they're really trying to get back to, with this standard, we want revenue to really depict the transfer of goods and services in amounts that reflect that. So they took a very pure, we want revenue to represent really when they've earned some revenue, in essence. So everything about this is trying to not get or trying to avoid some of the obtuse answers that GAAP sometimes has led us to. So they came out with a 5-step process, but I'm going to take us off on a slight bend for a second, if I can. One of my tasks at the firm is I'm the dean of our audit college, so all of our internal training, I have to try to distill some of these 300-400 page FASBs down to what like our staff 1s and 2s are able to digest and get out there. And what I always try to tell everyone is you have to understand the transactions first and then apply the accounting. If you try to learn some type of transaction from the accounting, it becomes very cumbersome. So with that, I'm going to just walk through a couple of images that kind of depict a sales transaction, and then we'll kind of layer in where the FASB went with this. And hopefully, by thinking about the revenue transaction for really what it is, it's two parties, coming to terms on what they're going to be buying and selling each other. Hopefully, the accounting will be a little easier to apply. So, every one of these transactions is going to have a seller. This guy looks very trustworthy. That's why I picked his image. And he's going to have, potentially a wide variety of things to sell. He's going to have goods, services. He could have warranties, training, multitude of things that he's delivering. And he's looking to sell them to anybody he can sell them to. The other side of the equation, we have a buyer. For those of you that aren't here, the buyer looks remarkably similar to me, except I have a mustache and a nose. So I don't know, I guess they just called it a day without putting those on. So you have a buyer, and he's in essence got, an undescript pile of money that he wants to use to buy his products. And one of the things I'll just mention about that is we all know as consumers that sometimes you really don't care what a seller says the goods are worth or the services are worth or the warranty's worth. If in total I'm comfortable paying the total, however they really say they're charging me, give me the goods for free and I'll pay you for the services, or give me the services for free and I'll give you the goods, it's all kind of marketing. And this standard does a good job of piercing through that. So, in essence, we've got this buyer who's got some consideration. And as a profession, as a company, as a registrant, what we need to really do is say we have a contract between these parties. What goods and services is the seller going to give the buyer? We know what the pot of money is that the buyer is willing to pay the seller. But part of the nuance is how much of that consideration do you really line up with each piece? And when is that piece delivered is really what's driving the revenue recognition. So there's a little bit of art and science to how you take that bag of money and say this much relates to the goods, this much relates to the services, this much relates to warranty or training. Because remember, what the seller puts in the contract may be nothing more than marketing. It might be buy one, get one free. It might be, any type of way he's trying to package it to make it sound like you're getting a good deal. They're free to do that. So the standard tries to pierce through that and kind of say, well, really, what am I really paying for each of these? And then it's, okay, I gave the seller my consideration. He gave me the product or the service, and now I'm able to recognize revenue when the blue line, represents delivery. So that's really the basics of what this standard is trying to capture, and we're going to kind of revert back and forth to this or parts of this image throughout the presentation. So I mentioned before the standard came up with 5 steps for revenue recognition. The first being you have to identify the contract. This is a very difficult one to say what's a contract. So the FASB did what I applaud in that they basically said your industry standard will drive what really is a contract. Before I mentioned you go to a retailer, you buy batteries, you give them some money, they give you some batteries and a receipt, and that is normal and customary for a retail transaction. If you're United Airlines, and I'm using them as an example because I think I saw United Airlines 9 times as I was circling to get here. If you're buying a Boeing aircraft from Boeing, I would imagine when they deliver the aircraft, it's not here's your receipt, thank you for shopping at Boeing. You're going to have, I saw an airplane lease this week. I mean, the thing was probably about 4 or 5 inches thick just to lease an aircraft, let alone buy one. So in the airline industry, normal and customary would certainly be a very robust set of documents to accompany a transaction. So what does that actually mean? So what that would mean would be if Boeing were to actually physically deliver the aircraft to United, but all those agreements didn't get executed until January of the next year, you don't have revenue recognition because your normal and customary contract failed to get executed, even if they said, hey, you know what, the right person approved it, or they had the aircraft, or they had possession of it. Whatever the case is, the FASB was very specific, like whatever your normal and customary is, if you have an outlier, there's no revenue until you're back into your wheelhouse of a normal transaction. A couple other nuances regarding the contract. To the extent that either party is allowed to, in essence, vacate the contract before either party performs, the FASB says you really don't have a contract then until performance starts. So if it's kind of like, hey, give me this down payment and I'll start doing this, but you have a month before I break ground and we can both terminate the contract, there's really no event until performance starts. They don't want contracts that kind of say they're going to start, revenue starts getting recognized, they get vacated, and now nobody knows what to do with it. So they did put the brakes on. A couple other points that I'll mention, which is kind of interesting because GAAP had historically been relatively silent on it. They've included now guidance as to when do you combine multiple agreements, when do you separate agreements, and what happens if you modify an agreement. So if you think about it, you could have a company who's have a long-term solid relationship with a buyer and say, listen, we're not really hitting our numbers today for 2014. Let's restructure a couple of agreements, and I'll agree to pay you 1 million units at double the price, and then in January I'll sell you another 1 million units at half the price. So you're kind of getting the same pricing net, but they could be moving revenue into periods just by the way they're papering multiple contracts. FASB now, for the first time, has actually pierced through that and said there are times when you will have to combine contracts and say, in essence, that is a contract for 2 million units, not 2 buckets of 1 million, and you really have an average price per unit as opposed to saying, the first million was $200 a unit and the second million was $50 a unit. So they get into that a bit in this standard, and I think it makes for a better application of GAAP. I do find personally as an auditor by trade that could be very difficult to necessarily catch if there's multiple agreements really that relate to the same economic transaction with the vendor or seller. So I get it. I understand it. I hope the profession can properly address that. And modifications is another one that they get into, where if you have an agreement and you say in a future period we've modified an existing agreement to drop the unit price or change the quantities or whatever else, they've come out with guidance now on how you have a modification. And depending upon, it's very tedious accounting, and depending upon where you go with it, you could actually get to a point where you restate previously recognized revenue and say in the current period, the parties modified an agreement, and as such, previously recognized revenue is getting restated to be deferred into a future period. So they've taken a much more vocal stance on a lot of areas where the profession has, historically been a little quiet. If you guys have questions as we go along, just feel free, blurt them out.
Okay, I have a question. When you say agreement and contract, for a lot of us, we may have a vendor, broad scope vendor agreement, but there's individual purchase orders. So are you considering those individual purchase orders contract in the agreement? Because they can vary in price. Maybe it's netted in. Do you know what I mean? And it's,
in
that piece.
When you go to like the retail transaction, so I give them money, they give me batteries, I get a receipt. But yes, there's other overarching aspects of that agreement. If you look at the returns area at a Walmart, there's a thing that says you have 90 days to return it or whatever the days is, and what happens if you have a receipt, what happens if you don't have a receipt. So in essence, my little transaction, and I keep using batteries because I have 3 little kids, so I spent the last half of December going back and forth buying batteries. That's what I do, because every toy has a different size that I don't have. So there are overarching customer, agreements, terms that may hit multiple purchase orders, but what they're really looking at is purchase order by purchase order, contract by contract. Is someone trying to gain a different economic or accounting answer by saying, hey, I'll sell you this much, this quantity at $200 a unit, and then in January I'll start selling it to you for $100 a unit. You would be combining them under that circumstance. So said another way, if you normally sell it at $150 a unit, and all of a sudden you said, hey, let me sell you $1 million at $200 and $1 million at $100, and you paper it a month later, the FASB could still combine. If you issued December, recording it all at $200 a unit, and then you papered it after you issued, they could come back and say, in essence, the company entered into another agreement, which under the standard should have been combined, and now we should have dropped it down $50 a unit to more closely.
Price protection.
Yeah.
Price protection is a pain in the neck.
Yeah.
Price protection is there's a lot of pains in the neck. That's one. So good times are had by none. The second is identifying the performance obligations, and if you think back to that image, it's really what are the goods and services that the seller is promising to sell. They will be outlined in the contract under step one. And a couple things that they tried to come up with to identify how many things is the person really selling you is the idea of distinct. Is it really a distinct item? And I'll use a couple of quick examples for that because many times different people have different views. So if you were buying cable TV service, I'm sure we've all had cable at one point in time, and they said, yeah, sign a 2-year contract, and you have to pay us X dollars. We're going to have a guy go out, he'll install the box, do whatever. The cable company could argue that, hey, listen, I paid, pick the electronics manufacturer that actually made the cable box. I paid them $200–300 for the box. I incurred costs. I put it in the customer's spot. It's at their place. They control it. They're using it. I should get some revenue for the box. Really what the standard setter would say is that really distinct? So again, we started off with the concept of look at it from the customer's perspective. Did you buy a cable box?
No, I bought a service.
You bought 2 years of service. I mean, if they said to you, how upset would you be if I could give you the cable service without the box? I don't think any of us would really say, no, I really
I need that.
I need that. So it's really not a distinct performance obligation. No one would ever buy that as a standalone basis without the interdependent service. Oh, and by the way, if you told the customer we can do that service now without the box, would they care? And the answer is no. So that's not a distinct performance element, performance obligation. So what the FASB would say is when you've delivered it, installed it, all that other good stuff, there's no revenue in that. Whatever they pay you under the contract, you would still spread over the 24 months because in essence, it's a 2-year agreement. So distinct is similar to standalone value, which is a current GAAP concept. Whether or not that sounds familiar or not, it's similar to that. But the easiest way to muscle your way through this is I'm the customer. Is this thing really, could it be sold separately? Is it sold separately? Is it distinct? Would I ever buy that in and of itself? And that would drive whether or not it's a real performance obligation. So that one, depending upon the industry, can have a little more airplay. Cell phone industry, same thing. You get a phone. You paid X for the phone.
It's become like buying a car.
Yeah, it's becoming like buying a car. A lot of us, some carriers, the price of the phone is invisible and they just lock in 2-year contract. Others say price of the phone is X, pay it up front, or divide it by 24 months and pay a piece a month. So what they really want is, regardless of the marketing, the phone is here, sign up for 2 years, we'll give you the phone for free, or sign up for 2 years and we'll charge you $24 a month for the phone. The two carriers should really be coming to consistent revenue transactions because it's the same thing from the consumer's perspective. I made 24 payments and I have 2 years of phone coverage, so you have to look into that. Determine the transaction price is the third step, and that sounds easy. And again, I mentioned before, if you're in the typical manufacturing, retail, distribution, probably is. When you get into variable consideration, the horse is out of the barn under the new standard, and we'll talk about that a little bit. One of the things that they fought back and forth with was the collectability threshold. The IASB does not feel that collectability is a revenue recognition metric, so they think it'd be fine to have $100 million of revenues and collect zero and have $100 million of bad debt expense. We were much less enthused about that on this side of the ocean. So the FASB in the final turn of this document put the collectability as probable. And probable from a GAAP perspective, is a very high threshold. It's like 80–85% chance of collection. So we'll talk a little bit more about variable consideration. In essence, U.S. standards currently have taken a very wait-and-see approach. If you have variable consideration and it's waiting for some contingency in the future to be resolved, it was basically hold off on recognizing revenue until you know what you're actually going to get and then record something. Well, the FASB kind of said that's not really the economics of it, because you're delaying revenue recognition, but you know it's not going to be zero. So they said they're putting us into an estimation model where you have to now estimate what you think you're going to collect if you have a variable consideration model, which is potentially a very tedious aspect of this standard. So moving on to the fourth, this was when I showed, how do we take that buyer's total pot of consideration and allocate it to each piece. Each piece being two. We've got our performance obligations, and now we have to figure out how do we allocate it. And this is probably the biggest area where they've, in general, relaxed the rules a little bit. Step 4, it's impossible to say is revenue going to be faster or slower, but in general, step 4 is probably going to pick up the pace a little bit, depending upon industry, and we'll talk about that a little bit later. But they do make you estimate. They do want you to use the highest and best available evidence as to what each piece was. So if you think, you walk into an Apple store and you could buy an iPad, a case, a screen protector, and 9 other little accessories, chargers, or whatever for it, but they also serve a bundle somewhere. As an astute consumer, most of us would say, okay, well, I can add up the individual prices because everything in that bundle they sell separately, right? And as the consumer, you can say, I can tell if I buy the bundle, I'm saving some kind of money, but you can actually tell what each piece normally goes for. So relative to the whole thing, you have pretty good evidence. Where it gets a little more difficult is, take a car, for example. Like you buy a Mercedes or a BMW, you get a car, you get warranty. Sometimes you can buy warranty without a car, right? Not without a car, but you could buy extended warranty. So if you think about, do they ever sell that item separately? Is there a separate selling price for that warranty? There is. There's a market out there, sometimes from the manufacturers, sometimes with third-party insurance companies to sell warranty service. Okay, that's that. You can kind of see something. But a lot of these luxury cars, they also come with free maintenance. Well, you go to Mercedes and they tell you get 4 years free maintenance or whatever the number is. You can't say, no, you know what, I'd like to buy it without the maintenance. So that they have instances where they say, well, we sell it with maintenance, we sell it without, so you kind of know what maintenance costs. It's just, it always is bundled. So some aspects where you have always bundled arrangements under existing GAAP, you used to defer a little bit more. Here the FASB is saying estimate. If that item is never sold on a standalone basis, but it is a distinct performance obligation, start estimating. So that's one of the bigger changes with step 4. Go on to the 5th and final step. Recognize revenue when or as performance obligations are satisfied. That's simply when has the customer obtained control of the good or service. And some illustrations go a good way with this. It could be at a single point in time. Again, retail transaction, I have control as soon as I walk into the parking lot. I could destroy it. I could use it. I could keep it as a gift. I can do whatever I want with it. I control that at single point in time. They did maintain the over a period concept. Think percentage of completion under current GAAP. I'm not sure how many people here are in the construction industry or if percentage of completion is of any interest to anyone. But in short, when you think of control, if you hire someone to build a building for you, you might say, well, I don't control the building until the building's done. I have a certificate of occupancy and I can actually walk in there. So at first people were very worried that construction would now no longer be a ratable recognizing of revenue over a construction period, that it would all be day, the final day when you get the keys. But they basically said, since you own the land, you control that asset. So as they're building the building, you could say, Mr. Contractor, I hate you. You're no longer allowed on my site. I'm going to hire another contractor to finish it. They viewed that as customers actually controlling that. So you are, over time, giving them incremental control. One of the examples I'll use for that would be if you hired someone to put in a driveway for you, and they said, well, the materials are going to be 10 grand, and then it's going to be 10 grand for me to do the driveway. And they come out on December 31st and they drop off all the pavers and charge it 10 grand. Has he earned that 10 grand? And people might say, well, no, I hired him to put the driveway in and now I just have pavers. But under the control model, if I paid him the 10 grand and he disappeared off to Brazil with, a 22-year-old and said, I'm never coming back. I had a staff guy do this to me once. So I'm never coming back. If you look at it from the customer's perspective, I don't feel like I'm overly harmed. I paid 10 grand for 10 grand of materials, and I can hire somebody else to go put them in. So you always have to get back to what does the customer feel like. And if he charged me 10 grand as a deposit and never put anything there, now I feel harmed. Now I would sue him or do whatever I got to do to get my 10 grand back. If he's actually dropped the stuff off, I got to find a new guy, kind of a pain in the neck, but I don't really feel like, wow, I was really harmed. So under that view, from the customer perspective, he could legitimately recognize revenue for dropping off those materials, provided that what he charged me actually was reflective. If he charged me 18 grand and the whole deal was 20, maybe that's not right. But that's really the summary of this. We'll spend a couple minutes on some of the finer points. On step one, what's the contract? It must have commercial substance, must be approved by both parties. So even if you've been dealing with a counterparty for years, if it's normal and customary for them to send back the agreement signed, and they don't do it till January event. If someone's on vacation the last week of the year and you said, listen, I got a text from him while he was in Aruba, that's not normal for you. Sorry, it's still not a contract. And it must identify the enforceable rights. That's only interesting from the perspective of the FASB did, for the first time that I can really relate or recall, introduce this concept of legality, where they said, guy charged me $10,000 for $10,000 worth of pavers, I really would have little basis to sue him. If he charged me 10 grand and never delivered the pavers, I could probably have recourse to go after him. So it does introduce the concept of, don't lose sight of the fact that legality may prevail. Another area where you see this a lot is non-refundable payments. A lot of companies say, well, I can recognize revenue on it, it's non-refundable. And it's like, well, if you fail to do anything, see how fast the court is going to say, oh, well, it did say non-refundable. I mean, you'd have to pay it back. There's no revenue under the new standard. So that was a little nuance that they introduced, which, so the whole idea of non-recourse, or I'm sorry, non-refundable really carried 0% impact on whether or not revenue is recognized under the new standard. So that was kind of an interesting nuance. Under step two, a couple of other things to talk about. Does it have a distinct function? Do products have a distinct margin? If you're selling something that's completely interdependent, two pieces of machinery that have to be purchased together to be used, they might say you really don't have two distinct performance obligations. Said another way, let's say you're the company, you want to hire GE to put in a huge piece of manufacturing equipment, and it comes in two major components. They deliver component 1 December 31st, component 2 January 1st, but those two pieces are completely interdependent pieces of machinery. You don't get anything on the first until you put it in the second. You know, like if again, from the customer's perspective, okay, great, company came out and dropped off component 1 on December 31st, but I'm not happy because I want both. I actually ordered a mattress, and they sent me the mattress without Luxbury. Right. And I'm like, you're going to send me one first, send me that one, at least I can kind of get started. So the customer, I'm kind of like, well, I really don't feel like I have anything until I get the second piece. So, you know, that's kind of how you have to think through, you know, the distinct concept. A couple things on the transaction price. Time value of money. If you've got any type of payment stream going over longer than a year, the FASB said you need to present value it because you have interest. So you're going to have some amounts taken out of revenue and put into interest income. Instead of just saying the whole thing was transaction price, it's going to be a piece of each. And the big thing here is estimates of variable consideration. And this has pervasive impacts. There's a couple of different models that they propose that you could pick from one of the two models. But I will say this, it's beyond the scope of what we can do in an hour. We could probably do variable consideration for 2 hours. If you have variable consideration, you will be put into a model where you have to estimate it. There is a constraint that the FASB put in that they basically say estimate your variable consideration, but in no event should it be less than probable that you're going to get it. So again, they kind of threw a very high standard. Said another way, it would be improbable that you wouldn't get it. But you do have to estimate it now. So if you say, hey, listen, I might make anywhere from 500 grand to $1 million on this contract, we used to just wait and recognize zero until you figured it out. Now it would be, well, maybe it's 500, maybe it's 750, maybe it's $1 million, and I have to estimate it. So that's a big, big change to the standards. Allocating the transaction price, this one we can rip through a little more quickly. You will have to use your highest and best evidence. You know, if you sell it individually, you know, like you have a software company that sells software, and separately they'll sell hardware, and separately they'll sell training, and separately they'll sell, you know, some type of maintenance contract, and many times they sell it all together. You have to use your highest evidence. If you don't have that, you might say, well, what are the third parties? You know, are there other companies that may sell it separately even though we choose not to? And if you don't have that, you get right into an estimation model. They do not want revenue to be continually deferred just because you're not 100% sure. They want to force people more. I mean, estimates and fair value is where accounting is going. So the FASB is continually saying, use estimates, use fair value, use a market assessment. Cost plus margin is even worse. To me, as an auditor, cost plus margin gets to the point where I'm almost feel like I'm making stuff up at that point. And then you allocate the transaction price to each piece. So this one, I think, particularly in software, this one is going to significantly increase the rate that revenue is recognized because you're able to, in many industries, use a lower level of evidence than you could in the past. Recognize this when the performance obligations are satisfied. That's step 5. Again, this is the customer's perspective. Do they have physical possession? Do they have legal title? Do they have an unconditional obligation to pay? One thing that's interesting on this that they did throw up, if you make something that is so customized to a customer, so customer comes to you, they give you something that is so custom designed spec that if they don't take it, you'd never be able to sell this to someone else. They actually view that as customer control. So if I'm acting as the seller in good faith and I buy this, I produce this, and then at the last minute, the customer says, hey, you know what, I don't really want that. You know, legal ability to say, hey, listen, you and I entered into a contract in good faith. Would a court actually uphold my right as the seller to sell this? You know, maybe they would, because they said, hey, I'm completely harmed if you don't take this, because no one else would ever want it. That does constitute control. Like a branded product. They're basically saying that the customer was so instrumental in the design of that they actually are controlling.
But most of the time, those are like a prepaid arrangement. So do you recognize that when they pay for it, even though you haven't?
You could get ratable. You could get ratable over time. The actual industry application of this is still kind of getting some airplay. The AICPA has several task forces on this that are designed to try to help through this, but they're very, very early stages of giving out any specific industry guidance yet. So again, here we talk about control. You know, it could be transferred over time or at a point in time. So if you think of a good, goods are usually bam, all at once. Here, you get the good, I get the product. It could be a service provided over a short period of time. You know, I'm a geeky accountant. I try to have that arrow go a little bit slower than instant. Or it could be over a longer period of time, hence the slower arrow. So you could have revenue kind of mirroring how quickly is that being transferred to a person, and the revenue would mirror it. The timing of the cash payments has zero impact on revenue recognition. Refundable, non-refundable, timing of cash is bookkeeping. It has nothing to do with when you've earned it. So I just put up a couple of things here to show it. So let's say the goods went to the customer first. So this is still pivoting on that original example. So vendor sells the goods or delivers me the goods. He debits accounts receivable or on billed AR, depending on what he did. He credits revenue. He delivered it. He's done. When I make the payment, he debits cash and gets rid of his receivable. But he recognized it when he delivered it. If I pay first for the good, he gets cash. He has to credit a deferred revenue. And then ultimately, when he delivers me the good, then he gets to reverse the deferred revenue into revenue. And it's really that simple. So the cash is really, it doesn't matter. That's the simplest way to say it, but usually if I say it that way, people think I'm being smug. So it just doesn't drive the way it runs. So there's areas where there was very little gap written in the past. So I tried to summarize these on slide 17, and I understand you'll kind of be distributing the slides.
Yes.
Slide 17, I'm trying to depict a couple of the areas where there's a lot more guidance than was, you know, before. A lot of us as practitioners kind of had to make it up based on judgment or SEC comment letters or whatever the case is. Multiple element arrangements, they've written more about whether or not you're in a point-in-time revenue recognition model like retail or an overtime model. They've given you some guidance on that. Interestingly, and I mentioned this before, when do you combine contracts? When do you separate contracts? And what do you do when you modify an existing contract? Guidance never existed for this. It's all in there now. Variable consideration now. This is potentially significant. And if you're in an industry that has variable consideration and you don't do it now, you don't have to estimate it now, that's going to be a big impact. Time value of money we mentioned. They give you specific guidance on what do you do with costs. You know, I mentioned before, a lot of times, particularly since percentage of completion was how much cost have I incurred compared to how much do I think I'm going to incur, you know, what percentage am I along the way. I've done something, I've earned something, I've incurred costs, I must be entitled to some revenues. They kind of said, well, you may not be entitled to revenues, but we're going to give you some specific guidance on what you can do with those costs if maybe, you know, you get into deferring the cost. So you set up some type of asset so you don't recognize the cost. They gave you some guidance on that too. So those are areas with expanded guidance. Slide 18, I tried to summarize some areas where I think, or I should say broader than me, we, think that there's going to be potentially large differences to the way revenue is recognized. Real estate, construction, software, telecommunications, aerospace, contract manufacturing. If you think back on that slide I had early on that showed, the existing general principles and then all that industry guidance, these are some of the things that kind of fell into all that other stuff that used to have very specific guidance, and now they're trying to apply a very general model. Regardless of industry, the FASB said revenue recognition disclosures are pitiful, and I mean the disclosure requirements are going to be extensive, so everybody's getting hit with that. Even if you're Walmart and it's the same revenue as it always has been, you're going to have very robust disclosure requirements. I mentioned before that estimation is a big drum they're beating at the FASB. In this particular standard, the ability or the need to estimate variable consideration, the need to estimate or identify performance obligations is becoming a little more tedious. How much money gets allocated to each piece you're selling it, how you get allocated it, all areas where we are now going to be in an estimation model as opposed to the wait-and-see model. So big potential changes on this. I'll probably skip over the tax impacts. I mean, many times companies are going to have to adjust or ask for method changes to how they recognize revenue for tax. Otherwise, they might be coming up with book-to-tax differences just for revenue, which is kind of an odd thing. If you have international operations where you have transfer pricing studies, you may want to undertake new studies to see can you get it closer to what the GAAP accounting is going to be, or are you going to throw off differences? So there's more tax impacts to this than they originally, I think, maybe had anticipated. But it is worth looking at and getting tax specialists involved at your companies to take a look at it. Early on, I mentioned the time frame, so we have a slide on that. So if you think of, I used before a public company with a 2017 year end. So you see here it backs up to you'll be making disclosures in your current period filings, as a new accounting standard. The SEC has said if you're a public company, okay, it's cool for second quarter, third quarter of 2014 to say here's a new standard. We're still kind of looking at it, but over time they really want more and more disclosure as you get closer to adopting it. They don't want the same disclosure over a new accounting standard for 3 years. So the prior periods presented, the yellow bar, that's kind of like the tedious part where you're going to have to start tracking this under 2 sets of books starting 2015, or if you're private, 2016, so that you can properly reflect your back years. Potentially a pain in the neck. And as we go forward, I'm not sure exactly what the next slide is. Yeah, okay. What do you do? I mean, revenue is a routine transaction. Hopefully for most companies it's a very routine transaction. Many times it's done, executed by lower levels at a company. It's a shipping, receiving, dock. It's people that are running out to companies and actually installing the cable box or performing the service that may or may not be astute to this. So it's potentially, one of these standards, like when they write a derivative standard, you don't have to worry about your install clerk having to understand derivatives. When you have revenue, this permeates very, very detailed, hands-on aspects of the business that many times fall on people who are much less astute about accounting and auditing than they are about the job they're tasked with doing. So, how do we, as a corporate environment, create the controls in place, the systems in place to be able to help capture this is going to take time. So what we're really saying now is you really need to start with an assessment, internal assessment, engage firms to help assess, to say where are things potentially going to be different, so that once that's identified, you can start saying, what do I have to do controls-based to permeate throughout the business so that whoever's actually doing this stuff, the flip for revenue recognition happens when they do their job, which isn't going to be an accounting job, because this is like I said, this is the blood and guts of our businesses. These are the people that are doing the revenue transactions. So, policies and procedures manuals, whatever the case may be, internal training. As a professional services firm, I mean, we're running trainings internally to this all the time, to our tax professionals, our audit professionals, our audit committee institutes, whatever the case may be, to try to educate. That's the first part. Assess is the second, and then start figuring out, how do you actually get this to it's on autopilot. That's what you want. You think back to the Walmart example, they may not have to adjust much to it, but even a routine transaction at Walmart, I mean, it's like a bar scan, and it goes blip, it goes up to their satellite feed on the top of the building, and it's revenue, all system generated, all automated, with very little ability for pilot error at the actual, transaction point. And they've done that because they recognize that most likely they don't have a technical services partner from a public accounting firm, hopefully being a checkout clerk at the Walmart. So there's a lot to this one. It's very academically interesting. They did put a ton of examples right around page 70 of the standard. They put in 70, 80 examples, which I think help illustrate this. You may be better served by reading the examples than all the meat before it. It might start sparking your imagination as to the what-ifs. It will be different by company. It will be different by industry. It will be different by transaction cycle. So, I was at a FASB meeting, or a meeting that the FASB presented at, and the chief accounting officer of GE was there, and they were commenting that GE has hundreds and hundreds of lines of business, and they have to assess for every single business, what does this do? So there's no blanket approach. Step 4 may make revenue more accelerated. Step 5 may slow it down. You really have to start at the top, step 1, 2, 3, 4, 5, and see where it comes out. You may come out exactly where you are and say, you know what, that guy got me all worked up, that Mark Sabatez from Eisner-Amper. I thought it was going to be a huge deal, and we ended up right exactly where we are now. That's possible. It's very possible that after a lot of emotional effort, you're going to find you're right where you were, but it might not be. So
really, we report this to controllers more than.
Yeah.
Side deals are a big thing. People that are negotiating deals, salesmen, side deals, they start paper and stuff, and now you've got specific guidance on when you combine or split contracts, and they could be getting companies into a world of stuff that they thought they were just keeping a customer happy or making a deal. I hate to use that expression more than once, but I've seen more than one company shoot themselves in the foot on revenue recognition by a genuinely well-intentioned sales professional who didn't realize they were triggering a whole bunch of accounts. So. I'm out of breath. So I'm glad this wasn't 2 hours. You guys are probably even more glad than I am. Do we have any questions come in?
Yeah, we've actually had a couple questions come in. I'll pose them to you now. If anyone does have any questions, you guys can feel free to put them in the questions box, and I'll ask them to Mark as they come in. The first question that we have is, how is it determined when a customer gains control of product when it's delivered by a third-party carrier?
Ooh, that's a very interesting question. Sorry? It is the evidence of the terms. You would have to feel as a company that you obtained enough evidence that that delivery had occurred. I think that if the FASB wanted to get on their high horse, they would probably say that is consistent with current standards, that you would have to make sure that was delivered. Where this has a huge impact, and I'm not sure if this is the vein that this question was in, is with third-party payers. So if you think of, you have companies that are in the infusion business where they actually go out to patients and infuse a drug for that patient, whether it's a cancer drug or whatever, and they're getting paid from a third party, whether it's an insurance company, Medicare, Medicaid. So you have many interesting things where the person that you're providing the good or service to isn't even the same party that's paying you. And the wrinkle that makes with this standard is, at least when you're dealing with the person that you're giving the goods to and they're giving you the money, you have that natural self-preservation. Like, I'm unhappy because this person didn't do what they did, so I'm not going to pay the last part of the payment, or I'm going to fight them or whatever, or I'm not going to buy from them in the future. In the third-party payer world, Medicare, Medicaid, Blue Cross Blue Shield, they may not even really know that that person did or didn't get that drug infused on December 31st or whatever the case is. But it's a great question. You need to be able to build into your controls sufficient evidence that that service was performed before you be able to recognize revenue. And that one might slow things down because it may take longer to get that evidence.
We also have a follow-up question to that, and the question is, what is a practical application for invoicing for goods delivered by a third-party carrier?
I'm not sure I understand that question. I don't know if the person could maybe provide some further clarity to it. The one comment, my knee-jerk reaction would be, what you paper is less important than what you do. And they had that concept like historically in GAAP. So you might say no returns, all sales are final, and that's what your contract said. But current GAAP always said, hey, but if you routinely take back these returns even though you say you won't, what you do is more important than what you say you do. So you kind of look to what is the company really doing? Then what are they? I'll make this one other backdrop, because with the combination and the modification and the splitting rules, if people think that they would be able to affect a revenue outcome by kind of getting cute with how they paper things, they're probably spending more emotional effort than they're going to get any benefit out of. This is a very wisely crafted standard to try to prevent gamesmanship. I've heard people say, well, can't we just structure milestones to kind of get revenue any way we want? And the short answer is no. They've kind of handcuffed most ways to try to paper your way out of it.
All right. If you guys don't have any more questions in the room, I think we're a little bit past time, so I'm going to shut down the webinar. I'd like to thank everyone for taking the time to listen in on Mark's presentation today, and I hope you all got a lot of great value out of it. If you could, on your way out, just fill out the survey for us. It gives us and Mark a lot of great insight into things that we can do to better our webinars for the audience.
I'll just add one quick thing if I can. In the slide deck, my first and last name are there. If you do have questions that you were unable to ask today, or you're driving home tonight and you think about it and you want to email me, please feel free. My email address is mark.sabatez, that's actually in the deck, at eisneramper.com. I'm more than willing to, hear your questions and at least let you know what my thoughts are. So thank you, everyone. I do appreciate it. Thanks for having me, guys.
Thank you, Mark. Appreciate it.
All right, and just so that everyone on the line knows, we will be sending a follow-up email tomorrow with a copy of the webinar as well as Mark's contact information, so you guys will all get that for your use. So with that, thank you guys again. I hope you have a great rest of the day.
Thank you.
I'm sorry you didn't get your question out there.